Good morning from London. I'm Anna Edwards alongside Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Global bond markets take a disappointing Japanese debt auction in their stride. This after weak US data drove Treasury yields to a one-month low. Global equities tread water. The ECB is expected to lower rates today, but traders will be looking for clues on future cuts and the impact of trade turmoil on growth. And on Trump's agenda, the travel ban is back, with the president barring people from 12 countries from entering the US. Trump also warns Putin has indicated he'll retaliate for Ukraine's recent drone strikes.
Anna, the markets in something of a holding pattern this Thursday. Then European futures after 3 days of gains, 3 days of gains as well for US markets, currently pointing a little softer by 0.1%. We await, of course, that ECB rate decision, almost fully expected to cut rates by 25 basis points. FTSE 100 futures also a little softer, pointing lower by 0.1%. As you mentioned, relative stability in the Treasury markets, despite the fact that auction came in softer in terms of the demand than had been expected on average and versus estimates. The US benchmark 10-year currently at 4.36. Largely unmoved as a result of that. Euro in focus, of course, leading up to the ECB decision. And what we hear from Christine Lagarde, 114 right now on the single currency, a little softer by 0.1%. The countdown to the opening trade starts right now.
Good morning, everybody. It is Thursday, the 5th of June. Welcome to the opening trade. I'm here with Tom Mackenzie this morning. Good morning, Tom.
Good morning.
Let's talk about the things we need to cover this morning. The big stories, setting the agenda. We'll come to the travel ban in a little while. Yep. We'll come to Trump's global agenda in a little while. But let's start off with all the things moving markets, or not moving markets, because as you commented there, just talking us through the data, we see calmness, really, in Treasuries, in JGBs, crucially. And that is worth noting, because we have this weak auction, weakness defined as being the weakest since 2023, a 30-year long-end auction. There's been so much tension in that part of the market recently, and yet we don't see yields spiking. If anything, yields are still lower in Japan, and we didn't see Treasuries picking up on that either. And I suppose that fits with the lower yields narrative that we've seen of late. US data yesterday kind of confirming that with its weakness.
To your point, how much of the moves that we're seeing in JGBs today are a reflection of the rally that we saw in Treasuries yesterday on that weaker US data? Maybe as well expectations from the markets in Japan, those, of course, who are responsible for purchasing these longer dated bonds in Japan, that it could have been worse.
Yes.
But to your point, below estimates in terms of the bid to cover ratio, it's a broader narrative in terms of concerns about the longer dated story. When it comes to the bond markets, we know the BOJ is putting out feelers as well in terms of the markets. They may be rethinking their issuance at some time. And in a couple of weeks, we're going to get the BOJ decision, of course, their latest rate decision. And this will no doubt come up in terms of a factor as the BOJ is scrutinised.
So avoiding disaster seems to be the way that was described on the Markets Live blog. On that US data then, which is, as you say, pushing the bond markets in a similar direction to the comfort it has taken out of this Japanese story. Weakness in the ISM services, ADP, that private measure of job creation, also looking pretty weak. All of that pointing us towards non-farm payrolls. And, of course, today's big event in markets, the ECB, Tom.
The ECB, which is, again, almost fully expected to cut by 25 basis points. Interesting, we had Sabrina Kanish from Pictet Asset Management on the show earlier. She was saying we should not underestimate the potential of interest rate hikes in 2026, contingent on a calming of trade tensions between Europe and the US and that defence and infrastructure spending coming through. That could lead to an environment next year where you get rate hikes. But the focus today, of course, is on a cut from the ECB and what Christine Lagarde has to say about the future picture. They skip in July, and then go again in September. There's a lot of uncertainty.
Absolutely. We'll have lots of conversations about the ECB. Let's park the market narrative for the moment and talk about some of the themes that are on President Trump's global agenda. We've got NATO defence ministers meeting. You already heard from Pete Hegseth in the last hour of programming. He's on the ground in Europe, ready to talk about 5% widely defined defence spending. Interesting that President Trump overnight has been talking about his conversation. He had a 1-hour conversation, more than, with President Putin. And he says that Putin is indicating that he is going going to need to respond to Ukraine's what were widely discussed and described as very successful, kind of audacious attacks by Ukraine deep into Russia over the weekend. So those are some of the things that are on his agenda. He's also, I suppose, struggling to get to the art of the deal when it comes to Putin and peace, when it comes to Iran and uranium enrichment, when it comes to China. No call with the Chinese. We haven't had any indication from China that they're keen for any call to take place.
The art of the deal is being challenged right now. What was interesting out of that call, to your point, was not so much that Russia has said it's going to retaliate, but the fact that the messaging came from President Trump himself following that phone call. We know there is a package of sanctions, bone-crushing sanctions, ready in the Senate, ready to go. But again, a reminder that President Trump, it seems, is very reluctant to pull the trigger on additional sanctions on Russia, even as they threaten further military action in Ukraine.
And talking of military action, we have some of these arrival pictures coming too, as Mark Rutte at NATO then, in Brussels, NATO headquarters. It's defence ministers gathering today to discuss this 5% defence spending target. Later in the month, of course, it will be world leaders. So defence on our agenda, Trump's agenda, dominated by some of these global geopolitical conversations. Better news for President Trump, though, perhaps, and his trade agenda in some of the mood music coming out of that Europe-US conversation that took place in Paris yesterday. Some of the lines coming through from that, some of the quotes from Šefčovič and Greer, using words like pleased, advancing quickly, moving in the right direction. I mean, all of that sounds a world away from some of the commentary we've had from the Trump administration around their conversations with Europe.
They have reflected frustration, haven't they? Up until yesterday, when Jamie Greer, and that is important, Jamie Greer, actually, from the US side, suggesting that there has been that material progress. We continue to watch that, of course. And then President Trump reheating a former deeply controversial policy, of course, from his first term in office, which is this travel ban on people coming from, 12, 13 different nations. This apparently in response to the anti-Semitic attacks in Boulder, Colorado, from a gentleman, that's the accusation at least, the man accused and arrested, previously from Egypt. Egypt is not on the list, but this is a Trump policy response, it seems, to concerns about crime, particularly anti-Semitic attacks. But it's broad-based, and it may well be challenged again in the courts.
Yeah, absolutely. It could face legal challenge, but worth reflecting. This is a bit different to what he introduced back in 2017 or so in his first term, but it has a huge amount of similarity with that. That was also challenged in the courts on a number of fronts, and eventually the Supreme Court did give its OK to that policy to remain in place, adjusted. But no doubt the administration has learned a lot from the first time that they tried to do this. So there are some exemptions. It does very much echo the first term. We will watch to see how this one develops. So those are some of the big, broad, macro picture items on our agenda this morning. Let's move on to the earnings conversations, though, because we've just had numbers through from Wizz in the travel sector here in Europe. We've had net income numbers for the full year coming in well above estimates, €225.8 million. So that looked positive when we're looking back at the year ending March. But the company's saying they're not giving 2026 guidance given the lack of visibility. And they find they have something in common with lots of businesses around the world, no doubt. But let's talk to the CEO of Wizz, Joseph Ferradi, who joins us now around the desk. Joseph, very nice to speak to you. Thank you for coming in. So talk to us about a lack of visibility, not giving any guidance for 2026. That's not to do with President Trump's tariffs in your case. So what is that? Why are you not able to give any guidance?
It is just a very volatile world around us in terms of geopolitics, in terms of supply chain. And simply we are just lacking the visibility we need to guide the market. I think we have a pretty good grasp over the short term, how summer is building up, and we are actually very positive. There have been commentaries around demand in the airline industry. We're seeing demand is very intact. People want to fly, they are booking, they are buying tickets, so I feel very good about that. But you see the dollar, you see fuel, you see this whole looming tariff issue, you see continuous issues with supplying aircraft engines to the market. So simply this is just creating a level of volatility that we decided not to guide at the moment. But of course, we are going to hint what we are seeing, what we can expect, etc., to the market.
OK, but you can't hint today.
I cannot hint today. The only thing I can say today is that with regard to the short term, the next 3 to 4 months, we feel very good about demand. I think we understand costs coming to the business. We are largely hedged on macro, so I think we have eliminated the volatilities ourselves. But we don't know what's going to happen in 6 months or 9 months from now. I mean, the world is just changing so fast.
Or 9 hours, perhaps, some days, feels like.
9 hours.
So you're feeling pretty confident about the summer season. What does that mean for fares and pricing?
So we are looking at demand from two angles. Our ability to to fill the aircraft, and we are up versus last year in terms of booked load factor, 1 or 2 percentage points. So that's very good. And secondly, we are looking at the fares, whether we are able to charge for the inflationary pressure, and we are seeing an uplift on fares, a few percentage points again. So all in, it's not just holding demand, but actually we are improving the quality of demand from our perspective in terms of achieving higher unit revenue than what we achieved last year.
You touched on the tariff impact. What is the tariff impact? Just quantify that for us, given that you, of course, pulled your engines in from Pratt & Whitney, which is a US-based company.
Well, first, I think we would need to define what tariff is and how that applies in this industry. It has been, going back and forth. There are negotiations between the EU and the United States, incomplete yet. So I think we need to see the outcome of those negotiations. Wizz has a legal setting through a number of legal entities falling into different jurisdictions. So we have an entity in the United Kingdom, which I think is looking good vis-à-vis US tariffs. We have an entity in the European Union. We don't know whether it will look good or bad. So I think we will see what exactly tariff will mean in the industry and to us specifically. And we're going to decide how we're going to move ourselves in terms of jurisdictional approach for those issues. We think we are actually okay, to be honest. I mean, we don't think that we're going to be hugely affected by tariffs, right, unlike many of our competitors.
So you see ways of defining the geographic location of your deals or placing aircraft in certain geographies that essentially will allow you to minimise tariff impact?
I think so, for so long as we fully understand what's coming.
OK, and what would your message be to those tariff negotiators, to Maroš Šefčovič, as he goes into those rooms with Jameson Greer and tries to make progress on the trade agenda?
Well, I'm an economist. Lesson number 1 in economics is global trading, comparative advantages, etc. You cannot step beyond that kind of a theory. I think you have to let global trade work out based on its own logic. Tariff is a distortion, so I don't think that this is going to help. Now, obviously, you may want to protect your own economy, but you have to be very smart about it because you are dependent and you are interdependent.
Those back to the Pratt & Whitney engine issues, because of course they forced you to ground a number of planes. You previously said you expect that issue to be resolved by early 2027. Is that still your expectation? I think
we're going to see a significant improvement in terms of affection to the business in 2027. Whether this is going to get resolved early 27 or late 27, I don't know. I think this is something to be seen. Forecast remains quite unpredictable yet, a little better than before. But I think 2027 is going to be the big turning year.
And what about the summer? How do groundings look like? Have you got certainty around what the summer looks like from the supply side, from the amount of seats you're able to put into the market?
So last summer we had roughly around 45 aircraft grounded. This summer we are expecting around 35 aircraft to be grounded. But to be honest, this is not because necessarily Pratt & Whitney was doing such a great job for recovering the aircraft, but it is also because we invested a lot of capital into spare engines to make sure that we don't get overly subjected to the grounding. So all in, I think all parties make significant efforts to fly the fleet, but until 2027, this issue will stay with us.
That must be so demoralising and frustrating to see 35 aircraft parked up and not able to fly because of this issue.
It is demoralising, but I'm not in an emotional business. I'm in the business of running an airline.
Are you seeing Airbus delivery delays?
Some, but Airbus is doing a reasonable job relative to the rest of the industry. I think we are very happy with the way we are managing our Airbus relationship. There are issues, but I think we have ways of addressing those issues.
Yeah, and one of the delays was with the XLR jet. Where do you, just briefly, Joseph, where do you see opportunity to expand use of that kind of jet? Middle East, parts of Asia, where?
I think the XLR delivery delay was a one-off specific problem, which I think Airbus has come to grips with by now. So I'm actually quite relaxed about that issue. But with regard to the expansion of the XLR fleet, we're seeing that the Middle East is certainly a market, and India. Not from the United Kingdom, unfortunately, because we wouldn't be able to reach from the United Kingdom, but from Central Europe, like countries Poland, Hungary, Italy, Austria, etc., would be prime candidates for flying to India.
OK, Joseph, thank you so much. Thank you for joining us. Joseph Faradi, the CEO of Wizz Air.
Let's bring you some breaking news right now when it comes to the London Stock Exchange, and this is another significant blow. This is Wise. This is the money transfer business, formerly TransferWise, but now known as Wise. The board has concluded that they will be moving and transferring their primary listing from the LSE to the US. So another move from the London Stock Exchange to the US. The board has done a review into this. It intends to keep a secondary listing on the LSE. The transfer of primary listing is expected to expand the pool of investors and increase trading liquidity. The stock, in its lifetime, having listed in 2021, Anna, is up about just a mere 20% since 2021. But this had been and remained a flagship tech listing on the London Stock Exchange. Henrik Tarvikas and others who founded this business, formerly founders of Skype, very successful in terms of the growth that they've seen, but not being rewarded, it seems, the view from the board, properly in terms of the listing here in the UK.
This is an £11 billion market cap company then deciding that its interests are better served by a listing in the United States, perhaps concluding that their sector is better valued in the United States. There'll be lots of views on that. Really, another blow, as you say, to London, where we've seen companies from lots of different sectors, whether that's packaging and or whether it's gambling businesses, all kinds of different sectors deciding that they will get a better valuation if they go to the United States. And it's often a question we ask tech businesses, tech startups in the UK, isn't it? Because, you know, if they feel they're going to get a better valuation, their business model will be better understood in the United States. That's the temptation.
The signalling it sends is really damaging as well, because there will be other executives and other founders looking at this very closely and possibly reassessing their plans, despite what the LSE will say they have done to try and encourage these kind of companies to list here.
Coming up on the programme, Chrissy is not here, but she is still with us during the programme. She is in Berlin for us at the private capital forum that is called Super Return. She was there yesterday. She'll be there again today. She'll be speaking to a host of industry leaders over the next few hours. Plus, NATO defence ministers arrive in Brussels. We've already heard from Pete Hegseth pushing that 5% target as the alliance looks to push peace talks forward, despite warning possible further Russian attacks. That warning coming from President Trump, talking about his conversation he's had with President Putin. Up next, we'll look ahead to the ECB. Christine Lagarde is expected to lower rates today, but markets are looking at what the rate setters see happening in the future in July, September and onwards. If you have questions for our guests, please get involved in these conversations around this desk. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. Welcome back. Joining us now, Luigi Speranza, Global Head of Markets 360 and Chief Economist at BNP Paribas. Very nice to speak to you, Luigi. And great to have you here because we're looking ahead to non-farm payrolls tomorrow. We're looking ahead to the ECB today. And in the meantime, markets are sort of flat to negative, treading water a little bit. Will we hear anything, do you think, from Christine Lagarde and co later that will sort of ignite market spirits?
Well, I think the last thing the ECB will want to do today is surprise the markets in any way.
So no.
No, that's the answer. I mean, there was an interesting line in the account of the last meeting where some members suggested we should be a beacon of stability in view of the turbulence that we have in the markets. So I think I'll be very surprised of a surprise. So I think it will be a 25 basis point cut. The background here is a downward revision to growth and inflation forecast, which justifies the move. And in terms of message, I think there will be a lot of full optionality, agility, and this is justified uncertainty in terms of policy. But also, I think where rates are, like 2% is really in the middle of the range of neutral. So policy is not any longer restrictive, which justifies even more caution when it comes to the message going forward against, a background of kind of high policy uncertainty.
There is all that uncertainty. Is there still uncertainty about the inflation dynamics of the Eurozone? 1.9% on a headline level. Can they pop the champagne corks at this point in terms of the inflation story that they have conquered?
I think they will be kind of quite reassured by the data. It's not just the 1.9%, but I think there is a kind of sense that the disinflationary story is well established now. And I think we might go a bit lower than 2%, justifying some more easing. We have another cut in September in our scenario, so a skip in July to reflect this uncertainty, and then a cut more because the disinflation impact will continue to play out. But, if I look at the medium term, there are also upside elements. Clearly, the fiscal stance in the Eurozone is likely to get a bit more supportive.
Yeah. Luigi, what kind of assumptions do you make around the level of tariffs we're going to land on with the US? And I ask this because we've heard some seemingly comforting language around the amount of money that the Trump administration wants to raise from tariff revenue. And I mean comforting for bond markets, because bond markets have been nervous about the fiscal situation in the US, and so they find comfort in the fact he wants to raise a lot of revenue. But if he wants to raise a lot of revenue, does that mean higher tariffs on Europe?
Yeah. So, look, we can have a working assumption here, and the working assumption for us is we get to some 10% baseline, effectively against most countries the US trades with, and some higher tariffs in some specific sectors. Which means for the US, you started from there, a 15% effective tariff rate, which implies probably revenues around 3 trillion over 10 years, which is not far away from what the Office of the Budget kind of calculated. So that's true. 10%, what do you mean for Europe? Well, first of all, let me say, whatever number we end up with, the key element in the short term is uncertainty. That hits anyway, even with tariffs at zero eventually. 10% means some drag on growth, but nothing dramatic. And again, I think will be over time more than offset by a fiscal policy response.
That's the optimistic outlook on tariffs. If we get to, if the deal breaks down and we face Trump wrath and 50% tariffs by July, do ECB cuts and stimulus from Germany offset that pressure?
I think the ECB will have to go further than we assume, because, again, I have another cut in this scenario because of relatively benign assumptions of where we land up with tariff rates. So I would say the risks in the short term with a 50% tariff rate will be for the ECB to go further lower to respond. Why? Because in the short term, I think this is disinflationary. I think that's the key point for Europe. For the US, of course, is a boost to prices, and I think also inflation in the medium term, but that's another story.
Okay.
For the Eurozone, I think it's disinflationary, so the ECB will be able to respond.
And how does the euro and the strength of the euro factor into your thinking, Luigi?
Yeah. So I think this is a bit of a different story in a sense that the narrative for me has been a rotation away from US assets. And I think this will continue to get more legs, and the euro is likely to be one of the main beneficiaries of this narrative, and we see it going higher, nonetheless, to 118 is our target for the euro dollar. What's the story? Well, one point is on the macro side, the US economic performance is less exceptional. There is a reduced gap compared to the past. Policy uncertainty is another key element. And also, we mentioned already, the policy of the US administration unleashed a response, kind of fiscal policy in Europe, which will not reverse. So this is a kind of the silver lining. On a more technical basis, I think what we see from data is that Eurozone investors are overweight US assets and under-hedged. And this, I think, favor, again, this rotation, in particular, the impact on the currency. So stronger currency, which, again, backs the idea of containing inflation in the short term, allowing the ECB further scope for cuts in the
Okay, and 118 on euro dollar would help in terms of inflation story as well, arguably, in terms of the import of energy. 114 right now in the single currency. 118 is your target on that outflow still out of the US into European markets, despite the cuts that you forecast from the ECB today and then in September. Luigi, thank you very much indeed. As we lead up, of course, to that ECB decision later today, Luigi Speranza, Global Head of Markets 360 and Chief Economist at BNP Paribas.
Coming up on the programme, a renewed interest in Europe has become a dominant theme at this year's Super Return Private Capital Conference. We heard a lot about that yesterday from the conversations that Chrissy was having on the ground. More of that to come. This is Bloomberg. This is the opening trade. Welcome back, everybody. 30 minutes until the opening trade here in Europe. So the futures picture looks like this. A little bit of downside, perhaps, at the start of the European trading day. Down by, well, uniformly, 0.1%. And US futures also pointing a little bit lower. Nothing dramatic, but we're waiting for a lot of things. Waiting for the ECB today. Waiting for, perhaps, some fireworks at the White House later as we see the German Chancellor visiting President Trump. So global trade will no doubt be in the conversation. And we're waiting for non-farm payrolls tomorrow. Onto the bond markets, and again there we see a little bit more calmness than perhaps of late. Yesterday we saw buying of bonds in the United States, and that theme, Tom, seems to have gone a little bit global. We see a bit more of that in Europe this morning, and we saw some of that through the Asia session, driven by weaker data out of the US, and sort of putting to one side any difficulty in selling long-dated Japanese debt, which had up to now been a preoccupation in Japanese markets.
Yeah, and you talked just briefly about Germany as well, and the fiscal stimulus from Germany and the expectations. We've been discussing about ECB and the potential rate cuts as well. Two catalysts, arguably, to bring money into and continue money flows into the European markets. Money managers are showing renewed interest then in Europe as a destination for investment, with many seeing some of the changes in terms of the region as an area of relative economic stability compared to the US, at least for now. Let's take you live to Berlin and join Bloomberg's Kriti Gupta for day 2 of the Super Return Conference in Berlin. Kriti.
Tom, you nailed it. That's exactly what the sentiment is here. This idea that Europe's moment in the sun is not just in the public markets, it's very much in the private markets as well. And there are two key factors to that. Simply the idea that you are having this massive fiscal spend from Germany specifically, kind of moving the economic engine out of those stagflationary fears we had in this region, but also a reaction function to what you're seeing over in the States, and perhaps the instability that you've seen rock the markets emanating out of policy coming out of Washington. Those are two key themes that are affecting in terms of things like deal flow, affecting conversations, affecting even pressures from LPs into the private markets and how you actually source deals. So that has been a key theme that we've seen in the public markets, showing up in the private markets, and then kind of delaying, by the way, the increase, or I should say the IPOing story when it comes to the capital markets as well. So it's twofold. There's some optimism in Europe, but a little bit of cautious optimism if we can. That story gets a little bit more nuanced when we go sector by sector. And Tom, I know that you are very much into the technology beat, so I got the perfect guest for you specifically to talk about this in terms of how the private markets are playing perhaps the AI space and technology broadly. I'm joined here in Berlin by Rachel Arnold. She, of course, is at Vista Equity Partners, specializes in software investing, specifically when it comes to the lens of private markets. Rachel, a pleasure to have you.
Thank you for having me.
Of course, we're thrilled to have you. We're thrilled to I'm thrilled to nerd out a little bit here with you, because I think we talk so much about these private markets, maybe taking the tone from the public markets a little bit. So if we're seeing instability, if we're seeing volatility in the stock market, in the S&P 500, or even any other equity market around the world, how maybe secure or insulated are the private markets from that? And I think you're the perfect guest to talk about how that shows up in the tech space.
I appreciate that. You know, obviously volatility affects all businesses around the globe, and I think we were all thrilled to see the public markets start to stabilize a bit this past May. That said, the private markets have really normalized over the past 24 months. You know, I think as we came out of the post-COVID period, we saw a really strong return to fundamentals, a focus on quality, and a focus on, at the end of the day, a new growth playbook. The businesses that we focus on, enterprise software companies, primarily based in North America, really have kind of catalyzed around this idea of how does growth become sustainable through things like generative AI, classic operating practices, and then a return to profitability. And so I think you're seeing that reflected in both the deal flow as well as the valuations on the private side.
Talk to us about that deal flow, though. How much appetite is there right now? I feel like the AI momentum story has been certainly one that's shown up for quite some time. Is it still seeing that same excitement, that same optimism?
Absolutely. There's never been a better time to be an enterprise software investor, candidly. And I think AI is actually one of the strongest growth drivers we've seen in the history of enterprise software. With AI, we're seeing an incredible increase in productivity. And so when an organization buys an enterprise software product, on average, they get a 650% return on that investment before AI. And what we're now excited to see is, does the improvements from a productivity standpoint, are they incremental or are they exponential? We have a handful of companies in our portfolio that are leading the pack on this front, and I'm excited to say that actually not only are we seeing more of those exponential productivity impacts, we're seeing incredibly increased market opportunity for those businesses themselves.
How does that affect, perhaps, I mean, I know you operate in the small cap space specifically,
Yes.
but when you're thinking about the deal-making pipeline, when you're thinking about the capital markets, perhaps having a delayed opening or a delayed kind of return to their former glory, for lack of a better term, how does that affect the small cap space specifically?
Yeah, you know, what's great about the small cap space, so these are companies under 50 million in ARR. There's over 90,000 of them worldwide. And what's great about this part of the market is that companies that raised money in 2019 to 2021 are generally starting to look at the end of their cash runway. And so not only is there a distinct capital need, they also have conserved cash to wait for those valuations to come back, which means that their growth rates have been more muted more recently. Now, so for investors like us that care about capital efficiency, that really are thinking about the fundamentals of the businesses, we're able to partner with these founders in a really unique fashion that candidly, at the height of COVID and during the market run-up, there was a little bit more attention paid to these companies than there is now. And so it's creating just some really incredible investment opportunities. Actually, our deal flow is up, and I am excited to see kind of that play out through the rest of this year and next.
How do valuations factor into that? And again, I'm thinking of this from a very public market kind of standpoint here, where I think a lot of investors are looking around the world and they're saying, well, okay, Europe is looking kind of hot right now, and maybe technology requires a little bit more of diversification. You're talking about exposure in the United States in a place that is kind of the buzzword in technology right now, which is AI.
Yeah.
Does that mean higher valuations?
You know, for enterprise software specifically, I would say we've seen a normalization, and it hasn't actually gone up dramatically based on AI itself. I do think AI native businesses, so businesses that are built with AI technology underlying and or have products that are very AI forward, are getting top of the market, almost market run-up level valuations. I think we've seen that in some of the deals noted most recently, but I also think it's early. We haven't had a significant number of proof points yet, and so we're excited to see how that plays out as we get more companies bringing these products to market and as they're getting financing.
So talk to us a little bit about where the private markets kind of maybe bridge the gap in terms of things like financing, but also equity raising as well, when it comes to actually maybe accelerating the adoption of some of these new kind of enterprise software products as well.
Yeah, absolutely. So most of the innovation is happening on the private market side. So when you think about 100,000 software companies globally, 96% are private and 90% are under the 50 million ARR mark. And so it's a very large pool. I will say that the partnerships with the Anthropics, the Microsofts of the world are really the ways that these companies are starting to think about innovating and building the next generation of their solutions. That's actually something that we've really leaned on, are those types of partnerships to fuel that innovation. As it relates to how that translates into new products and longer term, the valuations, I think it's early, but again, very promising from an outlook standpoint.
Are you seeing any sort of pressure in terms of not only speaking to LPs at the conference perhaps, but also just in terms of being an American company operating in California and in this kind of very niche and frankly innovative sector at a time when perhaps momentum is shifting abroad? Are you getting that sense here in Berlin?
I haven't had quite that level of kind of feedback from our investors here in Berlin. I think that it is more muted, I think, in terms of tone, just given some of the geopolitical uncertainty. That said, I think there is a lot of excitement around AI globally. And I think there's more of a focus on that innovation than there is necessarily the geographic kind of focus of the businesses. And most businesses, from a software perspective, are developed in the United States. And so I'm seeing European investors still be very excited about the opportunity to invest.
And who are you speaking to in terms of getting that kind of opportunity? Is it international investors still flocking to a small cap space when perhaps the large caps are a little tapped out?
Yeah, I think investors have always been very excited about the small cap opportunity, just given the volume and given the opportunity set broadly. Right now, I think that also because there are so few institutional investors that are really understanding AI and are able to tap into it, it's creating a unique opportunity for those that lean in, which is where I think we're having a lot of conversations this week.
It's a fascinating one, and certainly one where we kind of see a little bit of those dots connected. Rachel Arnold, a pleasure to have you here.
Thank you for having me.
And of course, joining me right here in Berlin, Anna, Tom, I'll throw it right back to you. We just had a fascinating conversation with Rachel Arnold. We talk so much day in, day out about those lofty valuations in the public markets, in the tech sector. It turns out that's it's not really stemming some of the innovation you're seeing in the small caps and in the private markets either.
OK, great conversation, great interview. Bloomberg's Kriti Gupta on the ground for us at this Super Return Conference in Berlin, talking, of course, about the public and private markets, which ties us in to a topic that we're going to delve into in the next couple of minutes. This is some breaking news about 30 minutes ago or so. FinTech Wizz planning to shift its main listing from London to the US. We're going to break down the impact in today's Stocks to Watch. This is a major blow for the LSE. Coming up, this is Bloomberg.
Welcome back to the opening trade. We have one eye on Brussels today because defence ministers are gathering there for a NATO defence ministers meeting. We are looking at pictures of Boris Pistorius, the German defence minister. He's been talking about the size of the German army. The German army needs 50 to 60,000 additional soldiers. He's been telling journalists this morning as he heads in to that gathering in Brussels, Tom.
And defence spending may not be immediately on the agenda for the ECB, but it will likely be in 2026. The ECB today, of course, set to lower interest rates for an 8th time as President Donald Trump's jolts to global trade lower the outlook for growth and inflation. Our very own Lizzie Burden is on the ground in Frankfurt with a preview of that decision and what we can expect to hear from Christine Lagarde. Lizzie, where is your focus going to be today?
Well, I have to say it's not so much on the cut itself today that is very widely expected. I'd eat my hat if they don't cut by a quarter point today because, of course, the inflation backdrop is that it's down below the 2% target now at 1.9%. It fell in the month of May and Tuesday's data on not just the headline level but the core and services levels as well because you've got lower energy prices and a stronger euro against the dollar in the aftermath of President Donald Trump's so-called Liberation Day. So the focus today will be on the forecasts updated for inflation and growth, but also the range of scenarios that they're going to set out because there is just so much uncertainty. First of all, in the short term on the tariff front, we just don't know whether the US is going to raise tariffs on the EU from 10 to 50% at that July 9th deadline and how the EU is going to retaliate. We've got, of course, the German Chancellor Friedrich Merz at the White House today. We don't know as well how much China is going to dump cheap goods on the euro area. And in the meantime, all of the uncertainty just putting a brake on investment and growth here. But then in the longer term, we just don't know what the economic impact is going to be, as you say, of all of that defence spending, the infrastructure spending as well, because we just don't have concrete detail of the fiscal stimulus. So we'll look ahead to the NATO summit as well. But all of that hopefully going to be set out in the scenarios as much as possible. A very difficult time for anyone predicting the future at the ECB.
Yes, and so walk us through the debate then about the next cut. We've already spoken to Luigi Speranza this morning, Lizzie, whose view in the short term at least kind of in line with the markets about how many cuts we get for the remainder of this year.
Yes, so the big focus is on the July meeting, and by then you'll have 2 more inflation reports, 2 more PMI reports, a German budget for 2025, an outline budget for 2026, and of course we'll have passed that all-important 90-day tariff deadline. And so the question is, do they go again in July or do they wait this summer and go in September? Most economists think that they will actually pause till September, but the argument against that is that it creates a communications challenge, that you could confuse the market into thinking that the cuts are done and that it isn't just a pause. And, you know, the ECB itself has said that they don't want to be adding unnecessary surprises to an already volatile market. They want to be a beacon of stability. But look, the argument for waiting and seeing is that if you look at the consumer inflation expectations for the year ahead, it's 3.1%, and that's the highest since last February. So it may be that the ECB actually wants to wait and then turn to hiking rates. I really think in the press conference today, Christine Lagarde's going to want to keep her cards close to her chest when she's asked whether they go again in July. And the other question, Anna, that's I'm sure going to come up is Christine Lagarde herself going to stay as president of the ECB? Because they haven't denied the speculation that she's going to next be the leader of the World Economic Forum, because if you look at the data, at least she can say that she has tamed inflation.
Lizzie, thank you very much. Yeah, no doubt the future of Christine Lagarde's career will get some attention. Lizzie Burden at the ECB, of course, for us throughout the day. More from Lizzie later on in programming. Joining us now with his view on the markets, Bloomberg Markets Live cross-asset strategist Ven Ram. Ven, a lot to talk about this morning. Let's start with the ECB. Lizzie was setting us up there with our expectations. The future of Christine Lagarde, a cut in prospect in today's meeting, it would seem. What are you going to be focused on, from inflation successes to growth challenges?
Morning, Anna. As Lizzie was mentioning, I think a cut is almost a given. There was only one kind of dissent going into from what we have heard from recent speakers in recent days. But I think that, the cut is a given, but the question is what happens beyond today. I think that the ECB, considering that the trade talks with the US are still ongoing and there is the uncertainty that the US may bring back tariffs, it is possible that the ECB will want to keep its ammunition dry for another day, which means that they will want to signal that there's going to be a pause in rate cuts going forward. I think that many people on the Governing Council already think that 2% is the nominal neutral rate, and we will be approaching that this afternoon. So the question is, how are they going to communicate that? It's going to come down to the language of the statement. I think that they have previously indicated that they are going into a data-dependent and meeting-by-meeting approach, and I think they are going to tweak that language or introduce new language to suggest that they are going to be on hold after today's cut. I think possibly the next cut could come in as late as in September. So I think that, if you look at German front-end bonds, they are fully priced for this outcome. So any kind of revisions to the macroeconomic forecasts that are not as dovish as the market thinks may put some pressure on front-end German bonds.
OK, so watch front-end German bonds and scrutinise the statement and the language there. Talking of bonds, you've been doing a deep dive into some of the mechanics and the history of the Treasury market and what it tells us about opportunities now then. There's been this favoured trade, the steepen the trade, where you pile into the front end and you steer clear of the long end. Is that the right place to be? What does your analysis show in terms of where to sit along that Treasury curve?
So, Tom, what we did was we looked at the, how bond market returns have fared after major spikes in volatility. So we went back in data like 2 decades. And so we looked at various thresholds of spike in volatility, i.e. the MOVE index, and measured the returns on bonds, various segments of the bond treasury curve, exactly 1 year after those spikes in volatility, based on some predefined thresholds on the MOVE index. Now, what we found was a bit of a surprise. What we found was that the front end didn't do really well, which is not what you would expect, really, because when there is a spike in volatility, it usually accompanies some distress in the economy. And that is the time when the Fed comes out and says, we need to accommodate the weakness in the economy. We will cut rates. So you would expect the front end to do well in that scenario. But that's not what we saw in the analysis. Another key finding in the analysis was that the 7 to 20-year segment of the markets do the best in the long term.
OK, so maybe target the 7 to 20-year part of the Treasury market in this environment. Bloomberg Markets Live's Ven Ram with the analysis. Thank you. You can get further analysis from Ven and the rest of the team by going to MLive Go on your terminal. Let's get your stocks to watch now. Joe Easton from our equities team standing by with a focus on Wise. Joe.
Morning, Tom. So Wise is the main UK stock with earnings out today. So we have got actually pretty much better than expected results from the company. This is the company behind TransferWise, the payments firm. But the big news today is that they are potentially actually going to be relisting to the US, so switching that share listing over to New York, potentially looking for a better valuation. But I was actually looking at the performance of the stock. It went public in 2021 when we had kind of a boom in listings in London. That was the same year we got Deliveroo, Doc Martens. Actually, Wise has actually been the outperforming stock since then. It's up around 20% or so, whereas the other stocks really underwater. So actually, it's actually performed pretty well. So maybe quite surprising that this is the company that's saying we're actually going to relist to another exchange, New York specifically. The earnings themselves looking pretty strong, an increase in the operating income, that kind of thing. But the main focus on the potential relisting. Then we've also got Wizz Air on the radar as well. Now, Wizz looks like another weak report from them. I was reading analysts at Jefferies saying potentially double-digit downgrades to consensus earnings. They've got really high costs and the pricing not doing well at the Eastern European-focused airline. That stock has underperformed, and what's stood out to me is all those sell ratings on the stock. 6 sells on that stock, almost as many as the buy ratings on Wizz Air. So it looks like another negative report from that one. So keep an eye on that one in London as well. And then finally, we've got a big upgrade for Bayer, the chemicals and pharmaceutical company. Goldman Sachs upgrading it to buy, saying that worries around the Roundup litigations. This was the weed killer in the US that had legal cases, potentially billions of dollars in payouts, compensation, because it was potentially cancerous. Goldman thinks that these concerns are overdone. Bayer's going to appeal one of the rulings to the Supreme Court, and they think if the Supreme Court accepts it, there could be 20% upside to the stock. So Goldman adds to the buy ratings, 9 buy ratings now. Goldman on that one. No sales on the stock, so potentially that's going to be higher. Already up around 3% on Tradegate. Keep an eye on that one in Germany today.
OK, thanks very much, Joe Easton from our equities team. Tom, just one other stock specific that could be in focus. Eutelsat in the satellite space. One of their shareholders, Hanwha, is selling a stake in this business, so we'll look for any downside pressure on that. But broadly speaking, the futures picture looks kind of flat to negative over in the US as well. Flat to negative on futures. Yeah,
Bonnie low by about 0.1% on both the S&P E-minis and Nasdaq 100 futures. 3 straight days of gains, modest gains for both US and European equities. That story, it seems, starting to fade today. European futures down by 0.1%. Looking for the next catalyst. Does it come from the ECB or does it come from the jobs data at the US on Friday? Plenty more coming up, including, of course, the Open. This is Bloomberg.
Welcome back. This is the opening trade. A few minutes to go then until we get the opening trade here in Europe. We cast our minds back to yesterday's session. Believe me, this is yesterday's session. So it looks more like a silhouette of a sort of mountain range. And I'm not sure it holds many clues as to where we go today. This is the European session in white, the US session there in the blue. Not really giving us much of a steer, but we are expecting we go a little bit weaker at the start of the European session, and then US futures are flat to negative. Waiting then, Tom, for the ECB. We're waiting for non-farm payrolls tomorrow, a host of other global geopolitical events taking place, and all of those always carry the risks of some headlines, of course. Eurostock 50 futures then are suggesting a little bit of weakness coming through. DAX futures also in the red. We've got a few stock specifics then, Tom, to focus on this morning.
Yeah, under the hood, there's some interesting stories in terms of some individual names out there. We were speaking, of course, to the CEO of Wizz Air on the back of their earnings. They came out with full-year net income that beat estimates. They're still struggling, of course, with the engine issues from Pratt & Whitney. So we watch that stock as well. So Wizz Air is in the mix. Wise, this is very damaging for the London Stock Exchange, looking to relist, keep a listing in the UK, but have their primary listing in the US. So watch that stock as well. It's up about 20% since its listing in 2021. Bayer also in focus, potentially some upside coming through here with Goldman Sachs upgrading their view to a buy from neutral on Bayer's shares, suggesting that maybe they could be upside as a result of the legal wranglings that maybe are coming to some kind of closure when it comes to Bayer and its US exposure. So watching Wise, Wizz Air and Bayer as well, Anna.
OK, so those are some of the individual names in focus this morning. Of course, that big focus, yes, on that Wise decision. We'll see if that has any impact on the way that the shares trade as we get closer to the open. Here we are, the start of European equity trading for this Thursday morning. The FTSE 100 out the gates and pretty flat this morning. The IBEX just a touch weaker. You didn't get a sense from looking at the futures picture that this would be a day that had big moves in store, and indeed we don't see those. The stock 600 then is almost entirely flat this morning. As I was mentioning earlier, we're looking at some big set-piece events, the ECB meeting later on today, the non-farm payrolls data out tomorrow. We also have the possibility of learning more about the trade agenda between Europe and the United States today. Could we get positive headlines coming out of that White House meeting between Friedrich Merz and Donald Trump, or will we get negative headlines and suggestions about where those conversations are going? So no doubt trade tariff news flow will be something that we'll be watching for as well today. That gives the markets a moment, Tom, to settle down, and they've settled down into not much action, it would seem. Yesterday, technology stocks were on the rise. I wonder what the sector picture looks like this morning.
Top of the list so far, top of the list in terms of the sector breakdown. Basic resources up 0.5%. Autos also posting some modest gains of 0.3%. The DAX print has not come through yet, but across the benchmark, FTSE 100 here in the UK, currently flat. The CAC current over in France, just up 0.1%. We wait, of course, for the DAX to open. On the downside on your sectors so far, media down 0.3%, utilities, travel and leisure. So we look at Wizz, of course, within the mix there, down 0.3% on travel and leisure. Again, tech amongst the gainers today on the sector story, something that Anna was highlighting in terms of the moves yesterday to the downside for tech. Today, tech up 0.3%, basic resources up 0.7 so far, Anna.
OK, so those are some of the some of the sectors. I mean, it's not a hugely compelling story this morning, is it? We're not seeing a huge amount of well, there's not a huge amount of news flow to drive these individual names and to drive these sectors. We're watching the Wise share price. That is on the rise this morning as it announces its move. Let's broaden the conversation, shall we?
A Wise decision?
Yes, that sounds good.
OK, gaining so far, as you say, 4% on Wise. We'll get that detail on that story as well later in this show. Let's get a broader take on these markets then. I'm bringing Caroline Raab, cross-asset strategist at Deutsche Bank Research. Caroline, thank you for joining us. What is the next catalyst for these markets?
Yeah, we'll have a lot of catalysts coming up today, actually. We'll have the ECB meeting later today. We expect a 25 basis point cut from the ECB, as broader markets also expect. We will have Friedrich Merz in the US today meeting Donald Trump. So also the trade topic will probably come up. Negotiations are going quite well so far. So we expect to reach a deal between the US and the EU in the coming months. But there will probably still be some ups and downs on the trade, negotiations.
Yes, we have. We've heard some more positive noises, haven't we, Caroline, from the most recent meeting between Maroš Šefčovič and his US counterpart. We're hearing some more positive mood music. That sounds quite different from just weeks ago. Do you think it is trade that still has the potential to deliver headlines, or do we see kind of diminishing response function to those trade headlines by markets?
Yes, we clearly do see a diminishing response function. I mean, we've seen that over the past weekend when there was a short period when Trump announced that European tariffs should be doubled. We've also seen not much of a reaction on the doubled aluminium and steel tariffs. But now we do see from both sides confirming, both the EU, both the US, that trade talks are going pretty well. So we remain quite optimistic that a deal can be reached, but we wouldn't expect that, while these ups and downs along the way occur, that market reactions will be as big as we've seen on Liberation Day, for example, when markets were still more cautious and more nervous around trade, clearly.
Caroline, with your cross-asset hat on, what is the euro strength story doing to the corporate earnings outlook for European corporates?
Yeah, I wouldn't call it that much of a euro strength story, but rather a US dollar weakness story. And I mean, we've seen that again yesterday with weaker US data rolling in. We've seen another decline in the US dollar with the weaker ISM print, the weaker job data print yesterday. And then, of course, a stronger euro is not great for European earnings. Our estimate is that any 10% move in the US dollar lowers European earnings by 2 to 3%. But we've seen that this year already, right? We've seen the dollar weaken by 10%. And we've also seen European earnings revisions down by 5% since Liberation Day. So I would expect that a lot of that is already reflected. But of course, any further strengthening of the euro would probably, result in further downward revisions in European earnings.
Carolyn, thinking about the European stocks environment, do you see pressure on European companies to consider listing in the United States? We talk a lot about that here in London, and we've had news around Wizz, the fintech business, that they are going to be doing that, moving their primary listing. But away from that particular stock, is this a broad theme that even over in Germany is discussed as well?
I mean, that is a theme that has come up in the past years. We've seen stocks delist from the German market and only have their primary listing in the US. I don't think that's a broad trend. I mean, it probably also has a bit of a sector bias, for example, in biotech, in pharma. But I don't think that's a broad trend. And you also have to consider that for European stocks, European companies, the market is much more competitive, of course, in the US to reach or to get to an index listing, for example. So also considering this year's equity move and the increasingly positive sentiment on European markets, and also US investors now starting to invest more into European equities, I don't think that's a trend that will persist over a long time. So I don't think that's a broader trend.
Okay, interesting. In terms of that upside that we've seen with that focus on Germany for the moment, the upside that we've seen for the DAX, the broader DAX, up what 20% year to date. The MDAX, is there a catch-up story with the MDAX, the mid cap, more domestically focused German stocks? Is that an opportunity that investors can engage with at this point?
Yeah, so the MDAX is our favorite index within Europe, actually, and as you've said, the DAX has already rallied quite substantially, right? It's one of the best indices this year, more than 20% up. And valuations in the DAX have also become, a bit expensive now. So we see less relative upside for the DAX and more for the MDAX, which is still trading quite a bit below its long-term average PE. And then also on the domestic focus, so the MDAX has a bit more than 30% exposure, so revenue exposure, to Germany, while in the DAX, the revenue exposure is less than 20%. So if investors really want to play the German growth story, the German fiscal package, then the MDAX clearly would be the place to be. And we expect 7% more upside in the MDAX this year.
Yes, and away from the MDAX, back to the larger cap stocks, Caroline. Of course, the performance of German markets over the first quarter very much influenced by what the auto sector was able to deliver. Is the talk at Deutsche Bank at all around that sector turning a corner, drawing a line in the sand, being able to move on to better times, or we just need resolution on trade before we can get there?
Yes, of course, the auto sector is one of the sectors that is more punished by tariffs and has also moved most in terms of the tariff headlines. And then also, if we look at earnings, actually, auto earnings were among the weakest in Q1. They also dragged down the entire DAX earnings quite substantially. And there is not really an expectation that earnings growth will come back within autos that soon. So overall, we don't focus on the auto sector right now. We see strength in the broader sector of the DAX, but not so much in the auto sector. So we focus on classic manufacturing sectors, basic resources, chemicals, construction, but we would remain a bit more cautious on auto still.
Carolyn, thank you very much. Carolyn Raab, cross-asset strategist at Deutsche Bank Research. Thank you so much for joining us. Let's have a quick look at the core six, some large in-focus stocks across Europe right now. Novo Nordisk, LVMH, most of that list, in fact, moving higher. Not by a huge amount, but Novo Nordisk not doing too badly. A day for pharmaceuticals, perhaps. Nestlé is in retreat, just down by 0.3%. So that's the picture on the core six. Away from the core six, though, we should reflect on the weakness in Wizz Air this morning, Tom. And I know that we spoke to Joseph Varadi, the CEO, a little bit earlier on, and he was talking to us about, well, they've withdrawn their guidance, which is clearly something that's going to put downward pressure on your stock.
So in today's move, more than 20% downside. So the stock being hammered, to your point, more than wiping out the year-to-date gains. Up until today, you'd see gains about 16%. Over 12 months, you've seen losses of 30%. That has now, of course, been almost more than doubled on the moves to date. So to your point, yes, look, the CEO was talking about the fact that actually they're seeing a pretty solid summer season, but they do not have that clarity, that visibility. So they've withdrawn that 2026 guidance, and that appears to be the factor that investors are latching onto.
Yeah, absolutely. And then he was also talking quite resiliently about the tariff environment. Of course, that doesn't affect the flying of the planes necessarily, but the sourcing of the engines. He was talking about how there were a lot of ways that they could manage the registration and the location of these various aircraft to enable them to get around tariffs, but that doesn't seem to be enough.
Having that UK entity may be helpful, but for now, the focus is on the drop in the share price. Let's get more details on this and bring in Joe Easton from our equities team with an eye on the stocks to watch, and of course Wizz is front and centre as well. Joe.
So yeah, that's really the big stock to watch at the open of trading. Down 23% now for Wizz. Now, a lot of that due to the guidance being removed, as Tom was mentioning there, and also the costs looking worse than expected. As I said earlier, Jefferies were putting a note out earlier saying they're potentially going to see some big downgrades to earnings. So the costs per seat coming up is what Jefferies said, and that is already one of the big underperformers in terms of the airlines over the past year or so. So we're really adding to that, but that's a huge move and a lot of volatility in that stock at the moment. Then we go over to Eutelsat, one of their Asian investors, one of their big Korean investors, offloading a lot of stock at a discount. That had a big rally, of course, linked to the war in Ukraine and potentially exposure there with some of their satellites being used. So potentially just cashing in, booking a little bit of a cheeky profit on that one and selling that stock down. So down 13% on that one. Then we've got BE Semi, a bit of talk around some of the big US tech firms like Broadcom and AMD potentially doing a little bit more business for BE Semi's materials that they sell into the semiconductor machinery space. That seems to be the take on why that one is up. There is a story on the Bloomberg terminal from BI, worth checking that one out on the terminal. Then we have got Wise in focus, of course, listed in 2021. So did Doc Martens. Doc Martens has a trading update. People buying lots of new boots, apparently. So Doc Martens getting a boost from their sales, looking pretty strong in a trading update. But that stock down very sharply since they listed in 2021. So not really touching the sides in terms of a rebound on that one yet. Then finally, on your analyst ratings, Bayer, we did mention that one, Goldman upgrading it, saying that the risks around Roundup litigation is overdone and they think this could come up, this stock could rise if the Supreme Court rules in favour of Bayer. So that one getting a boost. And then finally, back in aviation, ending where we started, Airbus, that one is downgraded at Citi, which says that the weaker dollar is a risk for the company because they get sales in dollars and also costs in euros. So the FX impact is negative. And Airbus declining 0.9% in Paris this morning.
Joe, thank you. Joe Easton from our equities team. Now, as Joe was mentioning there, the British fintech Wise plans to transfer its primary listing from the LSE to New York. A real blow to London then, perhaps. Wise will maintain a secondary listing on the LSE. Let's bring in Bloomberg Europe ECM editor, European Capital Markets editor, Charles Capel, with us this morning. Charles, good to speak to you. So talk us through the rationale here. They are not the first company to come to this conclusion.
No, they're definitely not the first, and sadly fear that they may not be the last. It's the usual reasons. They're looking for more liquidity, they're looking for a different type of investor, and specifically they may be thinking about this idea, whether it's right or wrong, but this idea that investors in the US are more suited to tech stocks and high growth stocks, whereas investors in London, they like a nice dividend and they like some good return on their investment, whereas they are moving to the US perhaps to access that new pool of investors.
How damaging is this, do you think, Charles, to the LSE?
Look, it isn't a knockout blow, but the thing with the LSE is that to some extent it is death by 1,000 cuts. And it is the third negative thing to happen to the LSE this week, right? This week. So last night we had Cobalt Holdings pulling their IPO. They were due to raise $230 million, about $230 million. They pulled their IPO late last night. They were due to start trading this morning. On Monday or Tuesday we had Endivia. They were cancelling their secondary listing. About a year and a half ago, they moved their primary listing over to the US for the same reasons or similar reasons that Wise has moved their primary listing. Liquidity, different type of investor, more trading in their stock.
Now, the more this has happened, the more we have a sense of how these businesses then do when they go over to the US. I mean, it's not plain sailing, is it? Because to try and get in front of all of those analysts and investors that you think will value your business better, you might want to be in one of the indexes. Well, that's not guaranteed, is it? It's competitive if you go to the US.
It is really competitive, and that's one of the reasons, or one of the things that the LSE has going for it. You can be a darling in the LSE at a $15 billion market cap. You can be one of the exciting growth companies. But in the US, you're just another company. You need to really do something special in order to stand out, and that is quite difficult. So getting into those indexes, again, that's going to be competitive. That's one of the things that Wise wants to do. But Wise has also struggled getting index inclusion in the UK because of certain aspects of their share structure. They've got this dual-class share structure, which has meant it has been difficult to get into FTSE indexes.
Which is a frustration amongst founders as well in the UK in terms of that particular structure and the constraints on that. So a small fish in a big pond. We'll see if they can prove advantageous in terms of this move. If it works out for them, essentially in the US, which they say is a major growth market as well, which is another factor. Bloomberg's Charles Capel, thank you very much indeed, breaking down the Wise story for us and what it tells us about the LSE and listing in the UK. Coming up, the Sell America trade spurs renewed interest in Europe. We are live from Super Return in Berlin, speaking to even more influential voices from the world of private capital. That is next. This is Bloomberg.
Let us take you live then to Berlin. The Super Return event is still taking place. Capital markets and private markets very much in focus. Bloomberg's Kriti Gupta is there. Kriti.
Anna, thank you so much. We are here, as you say, in Berlin at Super Return, trying to cover these private markets, trying to navigate what the volatility that we're seeing in the public markets maybe helps or hinders the case for the private markets. I've got the perfect guest for you for this program. I'm joined here by Michael Bruun, a partner over at Goldman Sachs Asset Management. Michael, pleasure to have you on the program, as always. Good to see you. Talk to us a little bit about the volatility that we're seeing in these markets. We keep talking about this from a public market standpoint. How does that affect? Talk to us about the trip roll down into the private markets.
That's a very good question. So first of all, I mean, the economy is slowing down right now, and we believe that the tariffs will have a slowdown effect on economic growth and also continue to leave us with elevated levels of inflation. And it's also driving a meaningful amount of volatility. And so what we're seeing right now is that volatility is something that our portfolio companies need to navigate. It's something that all our CEOs need to get their head around. And so they're turning to us. They're turning to somebody with Goldman Sachs, large asset manager, both with a public and a large-scale private markets business. And they're turning to us to say, what are the insights that you have? How can we use your network? And how can we use all your value acceleration capabilities in order to navigate this? The good news is that we have a lot of lessons from COVID recently. And so one of those lessons is like all the decisions that you took during COVID, you have to revisit again now, and you need to get on with your value creation plans, and you may have to move a lot faster. So it's an environment that allows some of our CEOs to excel because they're moving faster on all their operational plans than they would have done in a less volatile environment. The volatility also means that founders of companies are turning to us to say, hey, I need a trusted partner to help navigate this. So on the new deal formation front, the volatility actually really helps us. It could be a founder, it could be a family. They really want that value-add partner. And then the corporates, they're trying to deal with the volatility by reducing complexity. So what they're doing is they're saying, let's look at all our non-core businesses and let's really get on with all those non-core asset dispositions. So the carve-out deal is really back on the table, and that's another way of dealing with volatility. The good news for us as private equity investors is that in the carve-out deals, there's usually a real opportunity to provide a lot of value add, a lot of operational improvements, because the big corporate has maybe a couple of core businesses that they're put most of their attention to, had less attention on the non-core businesses, and then we can come in and really drive value creation there.
Well, talk to us though about this capital market story. You and I were here a year ago, and we were talking about, well, you know, private markets are warming up. In about a year's time, 2025 is going to be the year where we see IPOs, we see a deal-making hit a new record. What happened to that in the face of this kind of instability, largely emanating from policy? But what happened to that? What does that timeline look like now for the capital markets to open up in true fashion?
So we did see in Q1 a tick up in activity. We actually had reasonably good conditions for that, also because credit markets have been incredibly strong, right? Credit spreads have been coming in, and if you think about the return equation for private equity, obviously the cost of leverage, the amount of leverage you can get plays a role, and actually that has all been moving in the right direction versus when you and I spoke last time. If I think about what happened then in the beginning of April and into May is that we got a lot of volatility, and that volatility has slowed down some of the deal formation. But if you ask investment teams all over the world, they will tell you that they're super busy working on their pipelines, and they are getting stuff done as well at this moment in time. One of the things that we have seen, that we have gotten done, also during April, also during the times of the most volatility, was in-market consolidation, where our platform deals were able to bolt on smaller assets that, again, are struggling to navigate this volatility, and said, with this level of uncertainty, we need a much stronger partner. We need many more insights. Let us come in, and when we can act as a synergistic partner, we can use our capabilities and then consolidate. So I think that deal activity will continue, but it would be nice to see somewhat lower volatility to really see a continuation of the trend in Q1.
Do you feel like you're getting lower volatility when it comes to Europe? There's an argument here that the instability, the volatility emanating out of the United States right now, the answer to that in the private and the public markets is just invest in Europe. How long does that last?
So first of all, we're a global manager, and I think you need to be balanced in your approach. So what we do is we can often look at the same interesting investment thematic in multiple geographies. So the concept of Europe, so like over the United States or United States over Europe, doesn't really exist. What we think a lot about is at the individual asset level, where is this the best opportunity? And so, for example, already in 2024, we saw a few opportunities where actually the price point at which we could get a certain sector exposure, maybe a services business, in Europe was at a real discount to where the similar asset was trading in the United States. And so we're leaning into that opportunity. It only gets better when you then take that asset and say, hey, the world's biggest end market is the United States. Let's turn around and then let's drive more growth in the United States, and maybe one day sell the asset in the United States. Because I think one thing that we as private equity investors always need to remember is at the day you enter an asset, you also need to start thinking about the exit.
Yeah.
And one thing we all know is that the depth and the liquidity of the US markets are so much greater than any other market in the world. And so you have to, at your investment committees, to have an eye on that. I do like the idea of taking assets and moving them across geographies and picking up maybe a valuation discount in one geography, but an exit opportunity in another geography. So we're working on that in services-led asset-like businesses.
I'm going to put you on the spot, 30 seconds. Talk to us a little bit about how that excellence in the States translates to the AI theme. Rich valuations in the public markets that show up in the private space?
So for us, we haven't invested a lot into like LMMs, like the epicenter of AI. We are doing the picks and shovels. We're doing all of the AI thematics related to enablement. So we invest into, for example, IT services companies that are proliferating AI into smaller companies. So we love that services asset-like thematic.
All right, Michael Bruun, covering a little bit of everything for us. We thank you so much. I'm going to throw it back to you in the studio there. That was Michael Bruun, a partner over at Goldman Sachs, talking to us a little bit about perhaps the optimism in the United States, not quite just over just yet. Of course, as a lot of folks do actually look to Europe in terms of expanding some of their portfolio. Anna and Tom.
Kriti, thank you very much. Bloomberg's Kriti Gupta, of course, at that Super Return Conference in Berlin. There'll be more from Kriti later this hour, later this morning. Plenty more conversations on private markets. Coming up, though, we will also focus on the ECB, widely expected to cut interest rates again today. But what will the central bank say about the path ahead? We're live in Frankfurt. That's next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session, 8:30 here in the UK. And sentiment has turned a little bit more positive now across European equities. US futures also on the front foot right now. The Stoxx 600 is up 0.2%. Top of the list is tech as a sector, up 0.7%. And S&P E-mini stateside up almost 0.2%. Now, investors are awaiting a potential decision from the European Central Bank. This could be a catalyst for the markets, and the language from Christine Lagarde as well, to lower interest rates for an 8th time as President Donald Trump's moves, of course, jolt global trade, land lower the growth outlook globally, of course. Inflation has come down to 1.9% now on a headline basis for the EU. For more, let's cross over to Lizzie Burden, who's standing by in Frankfurt with a preview of the ECB decision. Are they kind of, is this a cut from the ECB, Lizzie, and then they're done? What is the expectation in terms of the guidance going forward from the ECB today?
Well, the expectation, Tom, is this is the last easy cut from the ECB because, as you say, inflation's back below target. But beyond this meeting is when things get really cloudy in terms of the outlook. First, in the short term, on the tariff front, we just don't know whether the US is going to raise tariffs on the EU from 10 to 50% after that July 9th deadline, or how the EU is going to retaliate. And then in the longer term, we just don't know what the economic impact will be of all of this increased spending on infrastructure and defence. We're waiting for concrete details on that fiscal stimulus, which is why, in addition to the inflation and growth forecasts, which will be updated, we're expecting a range of scenarios to be published to account for all of that uncertainty. But the question, as you suggest, becomes, do they cut again in July, or do they wait until September? And economists expect September, but there are arguments against that, chiefly that it could create confusion in the market as to whether the pause is actually the end of rate cuts. And the last thing that the ECB wants to do is add surprises to an already volatile market. They say they want to be a beacon of stability. So I really do expect that President Lagarde is going to keep her cards very close to her chest at this press conference.
Lizzie, thank you very much. It's Lizzie Burden in Frankfurt with a preview then of what to expect from that Eurozone ECB rate decision. Sticking with German themes, the German Chancellor Friedrich Merz will meet President Trump in the White House later today. Merz has veered between boasting about common ground with Donald Trump to bemoaning the US president's volatility and even mocking his bravado. Now they meet for the first time face to face. We're joined now by Bloomberg's Marilyn Martin, who's been thinking a lot about what this meeting could look like. What kind of meeting then do we expect today, Marilyn?
Yeah, so this will for sure not be an easy meeting for Merz, just because the stakes are very high. So, of course, we have the military and the defense dimension of the whole issue. So there's the war in Ukraine still raging, Trump not being able to cut a deal yet, and also Trump repeatedly calling on Europe and on Germany to increase their defense spending, to do more for their own defense. So that's an issue that Merz needs to address in this meeting, just because it's a very existential issue for the continent. But there's also the economic issue, of course. So Germany is particularly vulnerable to Trump's trade policies, just because the whole post-war growth model of the German economy really relied on exports. And the biggest export market for Germany is the United States. So any tariff will be really painful for German firms, for German companies going forward. So this will, of course, not only spell trouble for the companies themselves, but also for Merz, who ran on a platform of reinvigorating economic growth for Germany.
OK, so the vulnerability is there on the tariff front when it comes to the German economy. Is there resilience, though, longer term, should those relations between Brussels and Washington deteriorate further from where they are now?
Well, actually, that's the critical point. Germany is in a very weak spot right now. There are a lot of structural issues compounding. So the German economy is not looking good right now. The industry is declining. Industrial production has been declining since 2017, late 2017. And the issue is that the pandemic was a big hit, of course, but also the energy crisis due to the war in Ukraine. Since then, the German economy has not been growing anymore. And a main issue is also that there are more and more job cuts coming in. So one economist we talked to said that there are 10,000 jobs being lost in German industry each month. So there's a lot of pessimism about the structural issues facing German economy. And the German government recognized that, Merz recognized that, by passing an infrastructure fund for 500 billion euros, so roughly $570 billion. But the key question will be whether this will actually be spent in a smart way so that the German economy will be on a sustainable footing again.
OK, 10,000 jobs a month just in that sector. Marilyn Martin, thank you very much indeed, with a look ahead to what could be a crucial and pretty consequential meeting between the German Chancellor and President Trump in the White House later today. Talking of President Trump, he has announced a travel ban affecting a dozen countries around the world, reinstating then one of the most controversial and defining measures from his first term.
Very simply, we cannot have open migration from any country where we cannot safely and reliably vet and screen those who seek to enter the United States. That is why today I am signing a new executive order placing travel restrictions on countries including Yemen, Somalia, Haiti, Libya, and numerous others.
For more, let's bring in Bloomberg's Charlie Wells. What details do we have about this reheated travel ban?
Tom, so this is taking a lot of people by surprise this morning, and this really is being billed as a response to the attacks that we saw over the weekend on an event in Boulder, Colorado, about Israeli hostages. And what we know is that this is an expansion, really, of this idea of that travel ban from the first Trump administration. So some countries included there. There's about a dozen directly affected: Afghanistan, Iran, Libya there. There are some partial bans as well for individuals from countries from the likes of, say, Cuba, from Venezuela, from Laos. And if we're going to use history as a guide, we are expected to see litigation on this. We're expected to see this work its way through the courts, just like it did. That first Trump travel ban worked its way through the courts. It was ultimately pared back. Trump was forced to make a lot of specifications on what this ban would mean. But in 2018, it was upheld in a 5-4 decision by the Supreme Court. So that expanded the ability that Trump has to enforce immigration. And in a lot of ways, this move is playing to his base. There are so many concerns from Trump voters about immigration, about safety. We've seen an expansion of deportations, a continuation of building that wall on the Mexican border. And so this plays into that base who want to see quick wins here.
Charlie, he's had a busy 24 hours, President Trump, hasn't he? Because as well as signing this executive order, he's also been talking to the Russian leader, Vladimir Putin, and divulging a little bit of what the content of that conversation was, in particular around Ukraine.
Anna, this really is the clearest signal yet that Trump's strategy to quickly resolve the conflict in Ukraine is hitting hurdles. Because he had this phone call with Putin. There's not a lot to show for it. Actually, what he has to show for it is a repetition of a Putin talking point that he will need to respond to the Ukrainian attacks deep within Russian territory from over the weekend, when Ukrainian drones managed to hit as far as Siberia within Russian territory. And so this is a sign, again, of some of these promises that Trump made on the campaign trail on immigration, on the conflict in Ukraine, that he could resolve them quickly with engagement. Those are not working right now.
Charlie, there are divisions domestically as well within the Republican Party. Increasingly, it seems fueled by Elon Musk and his pretty determined approach right now to take down this big, beautiful bill, as it's described by President Trump, that is now in the process of being looked at by the Senate. Elon Musk wants to, quote, kill this bill.
Striking words from someone who was at least temporary member of, or at least an advisor to the Trump administration just a few days ago, and who was the largest political donor in the 2024 campaign, who helped Republicans win across the board. Musk is now really taking issue with this $2.4 trillion price tag and encouraging Americans to engage with their lawmakers to try to, end this legislation. And it's looking shaky, right? Because this bill is still working its way through the legislature in the United States. It barely passed the House. We know that there is going to be a lot of debate. There's something of an uphill battle in the Senate because you have, on one hand, these deficit hawks who Musk really is speaking to, who do not like that price tag. You have people more in the center, like a kind of Lisa Murkowski from Alaska, whose state requires a lot of federal funding. And then you have the Trump hardliners. Now, these Trump hardliners have been given something of a gift from the Congressional Budget Office, which is nonpartisan, finding that at least as of mid-May, those Trump tariffs, if projected outward, those would bring in $2.8 trillion. So that would offset the cost of this tax bill, but that's based on a lot of estimates. So basically what we're seeing is a fraying of that Republican coalition that helped bring Trump into power, and signs that this legislation, this signature legislation that needs to be passed, could be facing trouble.
Charlie, thank you very much. Bloomberg's Charlie Wells covering off a few of the items on President Trump's agenda. A busy 24 hours it has been for the president. Coming up, enthusiasm around the Europe story dominating discussions at one of the world's biggest private market conferences. We've heard a lot about that theme already at Super Return in Berlin. Kriti Gupta is there for us. More from there shortly. This is Bloomberg.
Sentiment has changed.
The whole tariff events have impacted mostly, I would say, the growth in the U.S. Market forces, the so-called bond vigilantes, have woken up those to the concern about the growing deficit in the United States.
They are starting to pause or slow down, at least, their allocations to the U.S. Bomb that people are watching is tax policies and potentially a tax war.
Right now, the big focus is on rates and the deficit, obviously, as the current administration is focusing on their big, beautiful bill.
And this is mainly the result of the global trade war, the risk, the tariffs, although not knowing exactly what the impact will be. But Europe certainly appears more attractive now.
And people are seeing Europe as a safe haven at the moment.
Some of the private capital investors that Kriti has been speaking to at the Super Return event taking place in Berlin, discussing the opportunities in Europe. Let's head back to Kriti Gupta. She is at that event and joins us once again. Kriti.
Anna, thank you. As you said, yes, in Super Return in Berlin, where the conversation of the moment is just how long this moment in the sun for Europe actually lasts. My next guest is not only a Europe bull at the moment, but has been for some time. I'm thrilled to say he's flying in from Boston just to see us, I think, is a fair way to say it. John Maldonado joins me right here from Advent. Pleasure to have you. Walk me through the bull case of Europe right now.
So maybe than giving the macro bull case, I'll just give the micro bull case. This is how we're experiencing it. I've been surprised at the talk at the conference about the renaissance in Europe. I'm excited about it. It's not really a renaissance for us. We've been here for 35 years. It's our biggest region from a talent investment team perspective. And when we look at the tail of the tape for us, in the last 6 weeks, we've signed 2 deals in Europe. And it happens to be the case that right now we've got 4 deals under exclusivity, all in Europe, and a 5th that's a bilateral discussion heading toward exclusivity. So the level of activity that we're experiencing is not just a future renaissance. It feels like it is an incredibly active time and moment for us in Europe.
It's fascinating because we talked to some of your peers as well who've said actually the pipeline in Europe predates some of this volatility. The timing is just coincidental. But I am curious, there is also this added momentum that you're seeing from funds around the world that are suddenly saying, if you don't want to allocate new money to the U.S., you allocate it to Europe. I'm curious, though, what that does to things like valuations in Europe, what that does to deal absorption in Europe. Is that a concern?
Well, it could be over the longer term, but in the near term, people feel like on the back of a relatively slow deal-making environment in Europe over the last few years, that there's a lot of potential. There's a lot of latent assets. There's a lot of inventory sitting on the shelf in the private equity community writ large. And as you pointed out, there's going to be fiscal stimulus in Europe. There's going to be a rotation away, potentially, from U.S. from a deal-making perspective. It all stands to benefit Europe in the deal-making here.
What gets in the way of that?
What gets in the way of that? Well, if we have heightened volatility from whatever source that affects some of what's happening in Europe, that's going to create a valuation gap. Uncertainty and volatility is the enemy of deal-making. If whoever decides to throw some uncertainty in the mix, that could press pause. But on a relative capital market basis, people are more enthusiastic about the capital markets here and the prospects for both taking companies public. And the financing markets have been relatively stable across both sides of the pond.
So talk to us a little bit about that volatility and the effect on capital markets here. 2025 was supposed to be the year for capital markets. All that deal glut that we were seeing, I think for the past couple of years, post-COVID, it was all supposed to problem solved in 2025. Right. We're not there yet. How far do you think that can has been kicked down the road?
How far can it what?
How far has it been kicked down the road?
Well, hopefully not too far, because we're now sitting here today in the 4th year of muted deal making. And as I'm sure people know, you've got $3.6 trillion of just private equity assets that are sitting on the shelf. Not to mention non-private equity assets. You got 29,000 companies, and we really do need that inventory to become unstuck. We need the wheels of M&A to begin churning. other than the volatility and what had been a bid-ask spread, which had been keeping some deal makers on the fence, there's really nothing that should prevent that M&A from becoming unviewed.
Talk to us a little bit, though, about that financing that's coming. When you're speaking to your LPs, when you're speaking to other investors, where is the interest coming from geographically?
In terms of where they'd like to invest, it really depends on the LP, on the customer. So different parts of the world have different focus areas in terms of where they want to go risk on and risk off. There are some U.S. investors that have questions about China. There's some China investors that have questions about U.S.
Yeah.
There are European investors that are trying to figure out who they want to align with. So I really think it depends on which part of the country we're talking about.
So let's bring it back to the capital markets point that you brought up just a moment ago, which is this idea that ultimately if you don't, say IPO, if you don't have some sort of deal exit at the end of the day, what are the ways around that in the interim when there is that volatility, or do you adjust to the volatility and just accept that this is the new norm?
I think you need to adjust. I think you need to be creative. It's one of the calling cards that we've put out to our organization, which is you can't really wait and blame the capital markets and say, we just need somebody else or some other market to improve. Yeah. We had an incredibly productive year last year from an exit and entry perspective. We had our second best exit year ever, divesting $9.5 billion. Year to date through end of May, we've already divested $4 billion. And we've done that in very creative ways. We've done dividend recaps. We've done regular way recaps. We've done some controlled deals. So the message to the team is you have to think as much about the exits as you do about the entry. If you're not being really dialed in a harder exit environment, you're not going to get the outcome that we need for our investors.
So those workarounds that you kind of just outlined there or alluded to, is that enough to kind of quench some of the pressure perhaps coming from LPs around those deal exits?
It's going to have to be, right? Because we don't know, to your point, 25 is going to be the year. It, to date, is not the year. Everyone's hoping 26 is the year. We'll see if it is the year. But you can't, I famously made the prediction that 25 was going to be our year, and it wasn't. So we can only wait so long. We have to deliver liquidity for our investors. Otherwise, this glut in the system is going to become too immeasurable for us to solve. So it's going to have to be a solution.
Well, talk to us about from a sectoral perspective as well. We've talked all morning about the momentum in the AI space. We've talked certainly in Europe about momentum in more manufacturing or industrial-driven industries as well. We know your healthcare is kind of your baby in terms of your sector expertise. Walk us through those dynamics. Are you seeing bigger valuation changes between the sectors?
So it also depends on the country that you're talking about. So you've got some very idiosyncratic things happening in healthcare in the United States. Yeah. You've got some executive orders that could create substantive change in Medicaid, in big pharma, and that is creating, potentially not even a bid-ask spread in terms of valuation, but a question around how do you think about the future of industry? That type of ambiguity does make deal-making incredibly hard. But in Europe, in Asia, and Latin America, you're not dealing with the same type of ambiguity. So deal-making in pockets of healthcare can be as robust in those other regions as they ever have been.
So then very quickly, talk to us a little bit about what that reaction function is in the private markets that are famously illiquid, that operate a little bit slower than the public markets when you're dealing with those kind of changes in the healthcare space. But I feel like you could extrapolate that to an AI theme as well in terms of changes in the environment that you're navigating.
Well, I think it's going to create some pockets of, in the case of healthcare, an even more stuck perception, right? Because if you have an investment in and around, call it the pharma space, the biotech space, some of these executive orders are fundamentally game-changing for big pharma and for the profit pool of everything that sits downstream. And while you don't know whether big pharma is going to have the benefit of the same American profit pool, and the profit pool in America was in no small part the profit pool for big pharma, you think that what big pharma feeds below it in terms of all the service providers and data providers, until you have greater visibility into what they can downstream, you really are going to struggle to find homes for some assets.
A fascinating conversation from a sector perspective, the volatility on a more macro geographic perspective. Well, John Maldonado there. We thank you so much for joining us. We really appreciate it as well. Anna, Tom, that was John Maldonado over at Advent. He's joining us, of course, from Boston here in Berlin, talking to us about the fact that this European renaissance that you're hearing about at Super Return has already been in the works for some time, but really, coincidentally, the timing is showing up at a time when perhaps you're seeing more of the optimism bleed into the public markets.
Yeah, and the liquidity question as well, really fascinating. 2025, not the year, it turns out. Maybe next year. It has to be, he said, on liquidity. More from Kriti Gupta, of course, from the Super Return Conference in Berlin throughout the day. Just briefly on what else to be thinking about today, what else is on the docket. It's the NATO Defence Ministers meeting. We've seen Pete Hegseth of the US arriving earlier this morning. That's happening in Brussels. 1:15 p.m. UK time. It is, of course, the ECB rate decision. We're reporting live. Expected, of course, to cut by 25 basis points. And at 1:30 p.m, as we move ahead to non-farm payrolls on Friday, we're going to get US initial jobless claims. So further building out the picture of the labour market in the US. And at 4:45 p.m. UK time, one to watch, certainly, in terms of the potential optics of this. Germany's Merz, the Chancellor, at the White House. How much tension will there be in the room? Or maybe bonhomie? We'll see. Let's bring in Bloomberg's Valerie Teitel for more on the markets right now. And leading up to the session today, there was some anxiety around the Japanese bond auction of the 30-year. And indeed, that anxiety on some measures was justified because the bid-to-cover ratio was a lot weaker. It came in below the estimates. There wasn't as much demand, essentially, for the 30. And yet the market reaction has been relatively benign. Why?
It seems like the market was braced for a worse outcome on this auction. Yes, it was weak. It had the lowest demand ratio since 2023, but it does seem like people were braced for worse news, actually. We saw some reports of short covering going on in JGBs, and the yields rallied in the long end. We were watching this because it was only 2 weeks or so ago that a really bad long-end JGB auction kind of sparked a global fixed income sell-off. But this time, this morning at least, it did very little to impact Treasury yields. They held on to most of their rally from yesterday.
So two things that long-end bond markets have been worried about, Val. One has been the Japanese auctions, and the other has been fiscal sustainability in the United States. Now, the CBO, we were hearing from Charlie Wells earlier on, they've given some comfort, I suppose, to those who are concerned about fiscal sustainability. Talk us through what the CBO has said and what that means for bonds.
Yeah, I found it very interesting that the CBO even gave an estimate for tariff revenue over the next 10 years, coming in at $2.8 trillion. That's the number that they think that tariff income will be over the next 10 years. There was a lot of assumptions going into that, though, which might maybe or maybe not might put these bond vigilantes' worries to bed. They do assume that these tariffs that are currently in place are in place for 10 years, which might be a stretch to anyone's mind.
The current tariffs.
The current tariffs. So 30% on China, the steel and aluminum tariffs, not the higher ones that went in yesterday, but the 25%. Then the 25% car tariffs are also involved. So all the current tariffs are on.
But I suppose they are showing us a way that the maths can indicate that you don't lose money in this bill, that you don't create a worse fiscal situation by cutting taxes.
Exactly. And this might be something that the Republicans might really lean on in order to put the bond market worries to bed. In some ways, look, we had a phenomenal rally yesterday on the back of weak data. Those 10-year yields hit a one-month low at 435. So in some ways, some of those worries have been put to bed at the moment.
Yeah, Elon Musk not convinced at this point, it seems, on the other side of that argument. When it comes to the data in the US, there's been a lot that's come out this week. We have non-farms on Friday. What is your kind of takeaway right now in terms of the health of the US economy and how much softness we're seeing?
Look, I do think the ADP did cause a lot of jitters in the market yesterday about payrolls tomorrow. We did see the whisper number come down by 15K. So I do think there is some worries that we could get a soft print in tomorrow's NFP.
OK, so a lot of focus on that. I mean, I've had so many conversations over the years, many years, about ADP and the links into non-farm payrolls and whether there is one. But we'll see tomorrow whether that weakness is replicated. I think the market
is really bracing for the moment we get a negative payroll print.
Yeah, and, when will the cracks really show? When will the hard data catch up with the soft data? All these questions continue to be asked. Valerie Teitel, thank you very much for that. Coming up in programming, Bloomberg's Francine Lacroix will be speaking to Fortescue's Andrew Forrest. So that conversation coming to you at 9:45 London time. That is it for the opening trade. From Kriti in Berlin, from Tom and I around the desk here in London. The Pulse is up next. This is Bloomberg.